A few months ago, one of the most well-known names in real estate, Brandon Turner, had a very public loss where his syndication lost $15 million worth of investors' capital. This was a single apartment complex deal outside Houston. Real people's retirement, kids' college money, the exit strategy from medicine fund, gone. Now, here's the part that should actually unsettle you more, not less. Initially, the deal looked okay. Rents grew. Occupancy was high. It was ultimately a financing issue and the inability to refinance that caused a sale price that landed $15 million short of what was owed to investors. Now, if you are a PA, NP, or pharmacist and you've ever thought about investing in a private equity syndication, you probably saw this headline and felt your stomach tighten up. Is this something that could ever happen to me? Here's the thing. We're not going to spend this episode trashing Brandon Turner or talking about what went wrong on the operator side. That's honestly not that helpful unless you're going to be a GP or an operator or you're in deep due diligence on an LP position in a syndication. For almost everyone listening to this, going step by step through someone else's failure is not going to help you with the lesson you need to learn as the individual investor. It's actually a distraction from the actual lesson. The lesson is about you. Specifically, how do you mitigate your own risk of investing in a syndication like this? Now, before we talk about mitigating risk, first, what is a private equity syndication? In very simple terms, if you wanted to go out and buy an asset that's huge, you might not have enough money to do it as an individual. If you want to go buy a long-term rental, you can save up for the down payment, you can go get a mortgage, and you can do that. If you want to buy a $25 million apartment complex, most of us can't afford to do that on our own. That's where syndications come in. You have a GP or an operator, most likely a team of operators, that do the acquisition and the operations of getting that huge asset, doing whatever value add to it they're going to, and then making it cash flow. That's the operations side. As a non-operations person, as an individual investor, you can invest in an LP position where you give them money on the front end and then sit quietly while you get your cash flow distributions on the back end. This is the most passive form of income I've ever experienced personally. Outside of getting a dividend check, this is the most passive thing I've ever done. And so people love it because it's genuinely mailbox money. Now, the expression's kind of a misnomer because there's a lot of due diligence to do on the front end. But once you wire the money, there's nothing else to do, right? You sit back, you either get cash distributions or you don't. That really appeals to the crowd of medical professionals who says, I'm way too busy to be fixing toilets or dealing with messages from my Airbnb guest at 2 a.m. that they're out of toilet paper. Okay, there are plenty of perks to not being on the operations side, but there's plenty of downside as well. This is an illiquid investment. Almost all syndications have a 3 to 5 year holding period, meaning once you invest the money, you can't get back your principal for 3 to 5 years. On top of that, many of these are only offered to accredited investors, meaning you meet certain income or net worth criteria on the front end. And on top of that, they have relatively high minimum investments. Now, it varies, but most of these land at about $100,000 to start. Some will allow a minimum investment of $50,000, but $100,000 is the most common minimum buy-in, so that's the number we'll work with moving forward. Now that you know what a private equity syndication even is, let's talk about what happened here and how you can mitigate the risk of this happening. Honestly, every few years, a syndication publicly blows up. But really, there are a lot of syndications that go south. They're just not all over the news and all over social media because they're not being operated by Brandon Turner and his team. This happens. Good operators make mistakes. Great operators suffer from macroeconomic factors, maybe outside of their control. It's not a scandal. It's not like some type of weird scam. This is the nature of an illiquid, leveraged, multi-year investment. So if your takeaway from the Brandon Turner story is, I'm going to avoid that operator, you've actually missed the point. These have a potential for your invested capital to go to zero. That is a fact. And so your risk mitigation, while of course comes from doing due diligence and not only the operator, but the asset class and the deal itself, the biggest form of risk mitigation actually comes from appropriate asset allocation and appropriate sizing of your own position. This is the conversation no one has until they lose big. Okay, I'd rather have it with you now. Now, private equity syndications have some key pieces that make them extra dangerous, really, when it comes to concentration risk overall. One, they're illiquid. You can't sell your position next week if things go south. This is different than investing in an individual stock in a publicly traded company. Of course, you can lose all your money that way, right? We all have heard millions of stories. We've all heard endless stories of mergers or acquisitions that happen, and the next thing you know, all of your huge invested principal is now worth pennies on the dollar. That can happen when you have concentration risk in a stock, but it's not illiquid. You can sell it. You can sell your position. You cannot inside the illiquid period of a syndication investment. They're also leveraged, okay, which, as you know, magnifies the upside, but it also magnifies the downside. This was actually the primary issue with the Brandon Turner deal. It was the structure of the leverage that caused the big problem. Your capital or your return in this instance as well is highly dependent on an individual operator or a small team of operators making the decisions. When you are invested in a publicly traded company, although you can have key leaders that run it into the ground, there are typically more decision makers at play than what you may experience with a syndication. Lastly, there is a genuine, irreversible risk of principal loss. If you go buy a total U.S. stock index fund, the likelihood of that principal going to zero is so incredibly small. And if it did, well, we have like global economic collapse because you have taken every single publicly traded U.S. stock to $0, right? This is horrible. It's unfathomable to think about. And so if you're investing in funds, stock funds, for example, the likelihood of total loss of principal that's permanent is very low. We might see our principal go down, but then we have all of this history to look at of, V-shaped recoveries, and we can sit there and go, it's likely these are unrealized losses and this will come back in the future. The same is not true for the investment in the huge apartment complex that's not going well, right? There is a genuine risk of loss of 100% of invested capital. And most of the time that's irreversible. So here's how I think about it personally as someone who is invested in private equity syndications. Now, these are my own rules of thumb. You can decide if they apply to you and are in alignment with your risk tolerance. Personally, I would never invest more than 10% of my total investable assets with a single operator in a private equity syndication or multiple syndications. In my mind, having one small team of people driving my returns and my preservation of capital should be limited to a small percent of invested assets. And so if I have one team of operators that maybe I invest in their syndication into a certain asset class, I'm unlikely to continue to invest with that same team of operators to where 40, 50% of my whole invested assets lies with the success or failure of this one small team. To me, that's a concentration risk I'm not willing to face. And so 10% is my absolute cap. But me, being relatively conservative, I'd like to land more at the 5% range when we're talking about a single operator. Now, for private equity syndications as a whole, I will push that a little bit higher. Again, these are my own personal rules of thumb. I'm comfortable with total investable assets being up to 40% in the asset class of real estate itself. Now, I don't love the idea of 100% of that being in syndications because of the illiquid nature of private equity syndications. And so personally, I wouldn't have more than half of my total real estate allocation in the syndication space. Again, my own rules of thumb. I will never exceed 10% of my total investable assets in a syndication with one specific team of operators. I'm personally comfortable with up to 40% of my asset base being real estate, but I'm still going to limit probably half of that to private equity syndication because of the illiquid nature of the investment. Now, here's where most people stop. They go, okay, cool, 10%, that's fine. Yeah, I get it. I'm really interested in this. I like the idea of passive income. Okay, well, what does it take to have 10% of your invested asset base as the cap when the minimum buy is $100,000? Okay, simple math. You then need $1 million invested in order to be able to say, I'm going to invest $100,000 into this syndication with these operators and maintain that diversification principle that you selected at the beginning. Now, this is not, you need $1 million net worth. That includes your primary residence and your car and all this stuff. No, this is $1 million in invested assets. Very different. So if you're writing a $100,000 check for this and your invested assets are $400,000 or $500,000, you're not at 10%. You're at 20% or 25% sitting in an illiquid investment, which, as we saw with Brandon Turner, has a potential for total loss of principal. That is a betting the farm scenario that I'm not comfortable with. That is the number you should be looking at before you move forward with the deal. Not, can I afford the check, which is its own question, but can I afford the check and maintain the diversification I need to protect myself from the reality that these deals can go south? Now, you didn't get into medicine to be a real estate operator's silent partner on a bad year, right? Most of you have one particular asset that dwarfs everything else, which is your license and your ability to generate an income from it. You don't need to add another single point of failure risk on top of that. Syndications can be a legitimate piece of a diversified plan. And real estate done right with the right asset allocation is a very reasonable way to build wealth outside of the stock market. But reasonable allocation is the whole sentence, not reasonable deal, reasonable asset allocation. So before your next deal, before you wire the next check and invest in a private equity syndication for that passive income, do the math first. What percentage of your total invested assets would be going into this single deal with a single operator? What position within your whole portfolio do all of your private equity syndications make up? What percent of your whole portfolio is real estate in general? And if you have been investing in syndications, what percent of your total real estate allocation is in private equity syndications? What portion of your whole portfolio is liquid versus illiquid? If any of those numbers make you uncomfortable, or if you know, hey, if I lost this money entirely, I would have to work an extra 5 years of full-time clinical practice to make up for it, that's your answer. I'm not here to tell you private equity syndications are too good to be true and you should never invest in them, but I am here to remind you that with potential for reward comes risk, and the only way to protect yourself is to be aware of all of them and make the most informed decision you possibly can before you write that $100,000 check.